Did you know that most of the indicators used in trading on a platform called TradingView aren't very helpful? They don't lead to profitable trades on their own, making up only about 35% of successful trades. However, there's a way to improve this percentage dramatically by combining 2 or 3 indicators together. Doing this can increase the chances of successful trades to an average of 80%, as long as you choose the right combination. So in this video, I'll explain a technique using 3 specific indicators: the Lux Algo Super Richi indicator, the relative bandwidth, and Heiken Ashi RSI. When used together, these indicators can give you an impressive 92% success rate when trading any commodity. The best part is that this technique is not only effective but also easy to understand even for beginners. So, if you want to become a profitable trader, stick around and watch the whole video. Let's get started. Alright, let's get started on TradingView. We're going to use a special tool called the Super Richi indicator by Lux Algo to help us with our trading. Pay attention to the cloud and crossovers from the Tenkan and Kijun options. First, let's adjust a few settings. In the style settings, uncheck the Tenkan-sen and Kijun-sen. Then, change the first crossover to blue, which means a bullish crossover, and the cross under to yellow, indicating a bearish crossover. To make it easier to see, we'll change the plot background to dark green and increase its transparency. Similarly, we'll switch the color 2 option to dark pink and increase its transparency as well. Next, in the Inputs tab, we'll change the Senku span B to 21 and 9. The cloud doesn't predict future entries. It uses data from 26 periods ahead of the previous period. But for our strategy to work, we need to know the current price of the cloud. So, we'll change the displacement from 26 to 0. That's all we need to do for this indicator. Now, let's talk about the Super Richi indicator, which is a powerful combination of 2 famous indicators, Ichimoku and Super Trend. This clever tool helps us detect trends in the market and makes it easier to understand what's happening. When we see the cloud in green, it's a sign that it's a good time to consider buying in the market. On the other hand, if the cloud changes to pink, it's a signal that it might be a good time to think about selling. The crossovers give us points where the market might change direction. For example, if we see a blue signal on a pink cloud, it means that the market might be about to go up for a little while. In that case, we could wait for the trend to retrace before selling again. Similarly, if we see a yellow signal on a green cloud, it means the market might go down for a bit. We could wait for the trend to retrace before buying. But here's the thing. While this indicator can help us make profits, it can also be a bit tricky, especially when a trend is coming to an end. In those situations, we might get some false signals, and that could lead to losses. To avoid that, we'll need to add 2 more indicators to our strategy. Now, let's talk about another exciting indicator, the Heiken Ashi RSI. This indicator combines 2 different things: Heiken Ashi candles and the RSI oscillator. What it does is pretty cool. It smooths out some of the noise that can confuse us in the regular RSI indicators. So, just like the RSI, this indicator helps us figure out when the market is going too high or too low. When the candles move above the upper band line, it means the market might be getting too bullish, and when the candles dip below the lower band line, it's a sign that the market might be getting too bearish. Now, to make the most of this indicator, we need to focus on the color of the Heiken Ashi candlestick itself and filter out any confusing signals. When we see a green Heiken Ashi candlestick, it could be a good time to think about buying. But if the candles turn red, it might be better to consider a bearish direction and think about selling. To make it easier to understand, let's adjust some settings. In the style options, we'll uncheck a few things like RSI histogram, RSI shadow, RSI overlay, OB and OS options, and any background options. Once we do this, the chart will look much cleaner, and it will be simpler to spot the bullish and bearish candles. So, what does the Heiken Ashi RSI do for our strategy? It's like a helpful filter that lets us avoid some false signals during retracements. Let's take a look at a bullish retracement in an overall bullish trend. During this retracement, the Heiken Ashi RSI candlestick is red. But we wait for the next green candlestick to give us a clear sign to buy. And guess what? It turns out to be a successful trade. The same idea applies to bearish entries. When we notice a new bearish retracement in a bearish trend, and the Heiken Ashi RSI is on green, we wait for the next red RSI candlestick to signal a good time to sell. And you guessed it right. It proves to be another successful trade. However, as useful as this indicator is, it's not perfect. It might not entirely eliminate all false signals at the end of a trend. To handle that, we need to add one more important thing: a volatility indicator. This will help us take advantage of strong trending markets when the volatility is high. Alright, let's take our trading game to the next level by adding the relative bandwidth filter to our chart. This cool tool, courtesy of TradingScope, helps us figure out the volatility in the market, which is crucial for making smart trading decisions. Here's how it works. The script compares two things: the bandwidth of a longer time frame and the average true range of a shorter time frame. These measurements help us determine where the market's volatility is high or low. To get started, we'll make a few adjustments in the settings. Don't worry, it's easy. In the input section, we will change the length to 49, and if we want even better results, we can tweak the multiplier to 5. Once we've reset those parameters, it's time to fine-tune the style for better visualization. We'll make things less cluttered by unchecking the upper, lower, and signal options. And here comes the fun part. We'll make the relative bandwidth stand out by increasing its boldness and making it a clean white color. To add some clarity, we'll also increase the boldness of the middle option and give it a brighter blue color. Now, let's talk about what the relative bandwidth tells us. It's like a measuring stick for volatility. When the relative bandwidth is higher, it means the volatility in the market is relatively low. But when it's lower, it signals that the volatility is comparatively high. So, why does this matter? Well, understanding the volatility helps us make smarter trading decisions. It gives us insights into when the market is calm and when it's more turbulent. This can be really helpful in choosing the right moments to enter or exit trades. Now, in the next step, we'll uncover the secrets to using these fantastic indicators to improve our trading strategy. To identify a buy signal, we need to look for specific conditions in the charts. First, we want to see the cloud in green, which means prices are likely to keep going up. Then, we wait for a bullish retracement, which is a temporary price drop within the upward trend. To know when this retracement starts, we look for a yellow signal on a candlestick. When we spot the retracement point, we also check the Heiken Ashi RSI indicator, which shows red candles during this period. Another important factor is the relative bandwidth, which should be below the blue middle line. This indicates that the current trend is strong enough, and the retracement is likely to bounce back up. Valid volatility are those that are confirmed during the point at which we got our retracement signal. Once these conditions are met, we wait for the next green candlestick from the RSI indicator, as this determines the right time to enter a long trade. Before we open the trade, we need to ensure that no part of the EUR/GBP candlestick crosses below the cloud during the retracement window. If any part does cross, the entry becomes invalid, and we should avoid the trade. When all conditions align, we go ahead and open a long order. For the stop loss, which stands as a level to exit the trade if prices move against us, we use the lows of the cloud. As for the take profit, which stands as a level to exit the trade if prices reach our target, we aim for 1.6 times the risk. If all goes according to plan, the trade becomes successful, and we ride the trend to make profits. So here is a situation where we would have avoided a bullish trade. We had some specific conditions that needed to be met, like the cloud being green and the appearance of a yellow signal at a certain point on the chart. However, when we looked at the Heiken Ashi RSI indicator, it was also giving us an entry signal at that time. But here's the catch. When we carefully observed the price movement from the yellow signal to the entry signal, we noticed something important. The wick crossed below the cloud during that period. To make it easier to spot such situations, you can go to the Indicator menu tab and click on Visual Order, then select Bring to Front. This way, you can easily identify when our conditions become invalid. In this case, we could visibly see the wick above the cloud, which means the conditions were not right for that trade. So we would have to avoid such entries. On the other hand, for a trade where we expect prices to fall, we follow the opposite steps. We want to see the clouds in pink, indicating that prices will likely keep going down. We wait for a bearish retracement, and during this period, we look for a blue signal on a candlestick. We also ensure that the relative bandwidth is below the middle line to confirm the strength of the bearish trend. When we get a red candle from the RSI indicator, we check if any part of the UGBP candlestick crossed above the pink cloud from the blue signal to the entry signal. If it does, the trade becomes invalid, and we should avoid it. But if everything looks good, we go ahead and open a sell trade. For the stop loss, we use the highs of the cloud, and for the take profit, we aim for 1.6 times the risk. In conclusion, I would say this trading strategy is pretty good. However, if you want to get better results, I would highly suggest you backtest it with the indicators I just showed you. Okay traders, I hope you enjoyed this video. Thanks for watching and see you in the next one.